In a functioning global market, the same commodity cannot trade at two wildly different prices in two different locations for more than a few minutes. The reason is simple mathematics. When silver costs $83 in New York, but someone in Shanghai is willing to pay $130 for the exact same ounce, arbitrage traders should swarm the opportunity like sharks to blood. They buy cheap in America, ship the metal to China, sell high, pocket the difference. The price gap collapses. Equilibrium restores. This is not economic theory. This is how markets have worked for centuries. Except right now, that mechanism has completely failed. As you're watching this, silver on the Shanghai Gold Exchange is trading at the equivalent of $130 per troy ounce. The COMEX price in the United States is hovering around $83. That's a $47 spread, a 56% premium, and it's not closing. It's widening by the hour. This should be impossible. A 56% arbitrage opportunity sitting in plain sight with billions of dollars in profit available to anyone who can simply move metal from point A to point B represents a complete breakdown of market mechanics. When arbitrage fails at this scale, it means one of two things. Either physical barriers have made the trade impossible or one of the prices is a lie. In this case, it's both. What you're witnessing is the moment the Western paper silver market lost its credibility as a global price discovery mechanism. The number flashing on your screen, the one every news outlet reports as the price of silver, has become divorced from reality. It represents the cost of a contract, a promise, a derivative, not the metal itself. Meanwhile, in Shanghai, where contracts must be settled with actual delivery of physical bars into verified vaults, the market is revealing what silver actually costs when you demand the real thing. The implications extend far beyond precious metals. This is a stress test of the entire architecture that has governed global commodity pricing for half a century. That architecture is failing the test. China is not passively watching this happen. They are engineering it. Through a coordinated strategy spanning government policy, industrial demand, and capital controls, the Chinese system is systematically draining physical silver from Western vaults while paying whatever price is necessary. They have calculated that securing the metal now at any premium is cheaper than facing shortages later when their solar industry, their electronics manufacturing, and their strategic reserves all compete for a commodity that no longer flows freely across borders. The Western response has been to suppress the paper price through futures market manipulation, hoping the gap will close through some return to normalcy. It won't, because the fundamental condition has changed. The era when COMEX and the London Bullion Market Association could set global prices through paper contracts backed by fractional reserves is ending. The era of physical settlement and sovereign commodity control is beginning. This is not a temporary dislocation caused by shipping delays or currency fluctuations. This is a structural fracture. By the time this video ends, you will understand exactly why the arbitrage mechanism has broken what China's strategic endgame is, and why this trajectory leads inevitably to a repricing event that will devastate paper holders and vindicate those who moved to physical metal before the window closed. The $47 gap is not an anomaly. It's a message. The market is screaming that the emperor has no clothes. The only question is whether you're listening. To understand why this price gap represents a systemic failure, you need to grasp how commodity price discovery is supposed to work. For generations, the global silver price has been set through futures contracts traded on the COMEX in New York and the spot market in London. These exchanges operate on a fractional reserve model. The total value of paper contracts outstanding dwarfs the actual physical metal held in exchange-approved vaults, often by ratios exceeding 100 to 1. The system functions as long as most contract holders accept cash settlement rather than demanding physical delivery. It's similar to fractional reserve banking. Your bank doesn't keep all depositors' cash in the vault. As long as everyone doesn't withdraw simultaneously, the model holds. The moment confidence breaks and everyone demands their metal at once, the structure collapses. COMEX has always maintained that despite the high leverage, sufficient physical inventory exists to meet delivery demands because most traders are speculators who never intended to take possession. They're betting on price movements, not acquiring metal for industrial use or investment storage. For decades, this assumption held true. The exchange could set the global price through paper trading while holding relatively modest physical reserves. The arbitrage mechanism provided the crucial link between paper and physical markets. When premiums for physical metal rose above futures prices, traders would stand for delivery, take the bars, and sell them to whoever was paying the premium. This flow kept global prices aligned. If Shanghai offered a 5% premium over COMEX, arbitrageurs would ship metal east until the premium collapsed back to the cost of transport and insurance. That's the system as designed. Now let me show you how it's breaking. Shanghai has maintained a modest premium over Western prices for years, typically ranging from 5 to 10%. This reflected China's structural position as the world's largest silver importer and the transaction costs of moving metal across the Pacific. Market participants accepted this as normal. Then in the last 48 hours, the premium exploded from $10 per ounce to $20, then $30, now $47. This is not a gradual drift. This is a phased transition. Under normal conditions, this spread would trigger an immediate response. Major bullion banks and commodity trading houses would simultaneously buy COMEX futures, stand for delivery, charter cargo flights, and sell into Shanghai. The profit on a standard 1,000-ounce bar at current spreads exceeds $47,000. Subtract a few thousand for shipping, insurance, and vault fees, you're still clearing $40,000 in risk-free profit per bar. Scale that across a few hundred tons, and you're talking about billions in arbitrage gains sitting on the table. If you're starting to see the deeper pattern here, if you're connecting this to other market distortions you've noticed, that pattern recognition is valuable. A-like helps this analysis reach more people who need to see it, because what comes next reveals why this gap is not closing and why that failure exposes the entire commodity pricing system as fundamentally broken. The arbitrage is not happening because the traders who would normally execute it have learned through painful experience that COMEX cannot reliably deliver physical metal. When you stand for delivery, you don't receive immediate access to bars. You get delays, excuses, offers of cash settlement at a slight premium to make you go away quietly, or you're routed into complex exchange for physical mechanisms that push your claim into the equally depleted London market. The metal you contracted to receive either does not exist in unencumbered form or has been pledged to multiple claimants simultaneously. The publicly reported COMEX registered inventory numbers show available silver down 75% from peak levels. Alarming, but potentially manageable if accurate. The reality is worse. The metal that remains on the registry is heavily encumbered. It's been leased out as collateral for mining company loans. It's been pre-sold through forward contracts to industrial buyers. It's been posted as margin for short positions. The same 10 million ounces appear as an asset on multiple balance sheets, but it can only be physically delivered to one counterparty. When multiple claims converge, the fraud becomes visible. We are approaching that convergence point. What's driving the Shanghai premium to these extraordinary levels is not speculative fever. It's a calculated national strategy operating across three synchronized channels: industrial demand, investment flight, and state-directed accumulation. Each channel alone would create significant buying pressure. Combined, they're generating demand that global production cannot satisfy at anything close to current COMEX pricing. Start with the industrial component. China manufactures over 80% of the world's solar panels. Each gigawatt of installed solar capacity requires approximately 20 to 30 tons of silver for the photovoltaic cells. The country has committed to installing hundreds of gigawatts of new capacity over the next decade as part of its energy independence strategy. This translates to demand for tens of thousands of tons of metal that simply does not exist in available inventories. Chinese solar manufacturers have stopped relying on spot market purchases. They're signing multi-year offtake agreements directly with miners and refiners, paying premiums of 20, 30, even 50% above COMEX prices to lock in guaranteed supply. The calculation is straightforward. Without silver, their production lines stop. The entire supply chain collapses. A 50% premium today is cheap insurance against a complete shutdown tomorrow when competing bids have driven prices even higher. The electronics sector follows the same logic. Silver's unique properties, highest electrical conductivity of any element, highest thermal conductivity, make it irreplaceable in high-performance electronics, 5G infrastructure, and military applications. As tensions within the United States escalate and the possibility of sanctions or export controls increases, Chinese tech manufacturers are building strategic reserves far exceeding their immediate production needs. They're not buying for this quarter. They're buying for the next decade. Then you have the investment demand. China's property market has destroyed trillions in household wealth. The stock market remains volatile despite government intervention. The yuan faces devaluation pressure. Capital controls prevent easy flight to foreign assets. Where do Chinese citizens turn to protect their savings? Traditionally, gold served this function, but gold has already repriced significantly higher, making it expensive for smaller investors. Silver offers a lower entry point with potentially greater upside. The Shanghai Gold Exchange has reported record trading volumes in silver, with retail participation surging. These are not day traders chasing momentum. These are families converting life savings into something tangible, something the government cannot print into worthlessness. The scale of this wealth preservation demand is difficult to overstate. When hundreds of millions of people decide simultaneously that they need hard assets, the available supply evaporates. Beneath these visible demand channels runs a third, more opaque force: state-directed accumulation. China does not publish silver reserve data the way it reluctantly discloses gold holdings. But the pattern is unmistakable to anyone who watched how they handled rare earth elements. First, secure domestic production. Second, restrict exports. Third, accumulate strategic stockpiles. Fourth, weaponize control when geopolitically advantageous. They've already executed steps 1 and 2. Chinese silver mining production increasingly stays within domestic borders through export restrictions and bureaucratic barriers. Meanwhile, customs data shows surging imports from every available source: Peru, Mexico, Australia, any country producing refined silver. The metal flows in. It doesn't flow back out. This is the rare earth playbook applied to silver. In 2010, China controlled 95% of rare earth production and used that leverage to restrict exports during a diplomatic dispute with Japan. The world suddenly realized its vulnerability. Building alternative supply chains took over a decade and remains incomplete. Silver is following the same trajectory. By the time Western governments recognize what has happened, the strategic position will be locked in. The brilliance of the strategy is that it operates through seemingly independent market forces. Solar companies buying for legitimate production needs, investors seeking safe havens from domestic financial instability, refiners and traders responding to price signals. No single action appears aggressive or unusual, but orchestrated together, guided by state policy and coordinated through China's unique system of government influence over ostensibly private enterprise, the result is a systematic transfer of physical metal from west to east that cannot be easily reversed. And here's what the Western financial establishment didn't see coming. They assumed paper markets could maintain price control indefinitely through futures market short positions and fractional reserve practices. They assumed physical demand would remain fragmented and responsive to their price signals. They assumed China would play by the rules of a system designed to benefit Western financial institutions. Every assumption was wrong. The $47 gap is not a market inefficiency. It's a price discovery rebellion. Two different markets are revealing two fundamentally different realities. COMEX trades promises. Shanghai trades metal. The divergence in price reflects the divergence in what's actually being exchanged. When you see $83 on a Western price feed, you're looking at the cost of a derivative contract, a legal claim to silver that may or may not be fulfilled with physical delivery. The price is set by speculators' trading contracts, backed by fractional reserves in a system where most participants never intend to take possession. It's a casino where chips are traded, but rarely cashed in. As long as most players stay at the table, the house maintains control. When Shanghai quotes $130, that number represents actual metal changing hands between verified vaults with audited inventory where delivery is mandatory and settlement is physical. That's not a promise. That's the transfer of a tangible asset with intrinsic properties that cannot be printed or created through financial engineering. The distinction is everything. One price is fiction maintained through market manipulation and fractional reserve alchemy. The other is reality enforced through physical constraints and sovereign demand. As the gap widens, the question every investor must answer is which price represents the future and which represents a dying past. China has made its choice clear. By bidding the physical price to 130 while COMEX flounders at 83, they're forcing the West to reveal the weakness of its position. Every ounce that leaves a COMEX-approved vault and ships to Shanghai is an ounce that never returns to the Western paper ecosystem. The metal is gone, permanently. It enters Chinese strategic reserves or industrial supply chains, where it's consumed and cannot be recycled back into tradable form. This creates a death spiral for the paper market. As physical inventory drains, the fractional reserve ratio increases. More paper claims chase fewer actual ounces. The system becomes increasingly fragile. Any surge in delivery demands could trigger a collapse. COMEX knows this. That's why they are desperately trying to suppress the paper price through short positions, and why they are increasingly resorting to cash settlements when traders demand delivery. But suppression has a cost. The wider the gap between the paper price they defend and the physical price the market will actually pay, the faster the drain accelerates. It's a trap of their own making. Lower the paper price to discourage delivery demands, and you widen the arbitrage gap, which increases the incentive to drain your inventory. Let the paper price rise to close the gap, and you trigger short squeezes and margin calls that could bring down the entire derivative structure. They're caught between two catastrophic outcomes with no good path forward. Now, here's the question that should keep every serious investor awake at night. If this dynamic plays out to its logical conclusion, if COMEX loses its role as global price setter because it cannot deliver metal at its quoted prices, what happens to the entire dollar-denominated commodity pricing system? Silver is not unique in its vulnerability to this attack vector. The same fractional reserve model, the same paper versus physical tension, exists in gold, copper, platinum, other strategic materials. If China can break Western price control in silver, they've demonstrated a playbook applicable across the entire commodity complex. This is about far more than one metal. This is about the architecture of global trade and the monetary system that underlies it. For 50 years, the world's most important commodities have been priced in dollars on Western exchanges. This gave the United States extraordinary financial leverage. the ability to sanction, to freeze assets, to control access to essential materials through the dollar payment system. If commodity pricing shifts to physical settlement markets denominated in yuan, where China controls supply, that leverage evaporates. The $47 gap is a geopolitical weapon aimed at the foundation of dollar hegemony. The BRICS nations are watching closely. Russia, India, Brazil, South Africa, the expanding coalition of countries seeking alternatives to Western financial dominance, they see this as a template. Break Western control over commodity pricing, establish physical settlement systems under sovereign control, denominate trade in local currencies or neutral alternatives, and the dollar's role as global reserve currency faces an existential challenge. This is why the U.S. government recently announced price floors for critical minerals. It's a defensive recognition that the game has changed, but price floors are not an offense. They're a reaction to a strategic disadvantage already in place. China is draining Western vaults while America scrambles to figure out policy responses that might incentivize domestic production years from now. The asymmetry is stark. Take a minute with that question. If commodity pricing power shifts from Western paper markets to Eastern physical markets, does the conventional wisdom about dollar dominance still hold? Or are we watching a fundamental reordering of global economic power in real time? Drop your analysis in the comments. Some of the sharpest insights on this channel come from you, and this moment deserves serious discussion. Let us map the probable sequence from here because the trajectory is clear, even if the timeline remains uncertain. The drain continues and accelerates. As long as Shanghai pays a massive premium over COMEX, physical silver flows east. Western vaults move closer to zero effective unencumbered inventory. Industrial users in the United States begin to panic. Companies like Tesla, Apple, solar manufacturers, defense contractors, they cannot run production lines on paper contracts. When they realize that COMEX prices don't guarantee access to actual metal, when they discover that Shanghai has already secured most available global supply, they'll be forced to bid against each other for whatever remains in Western markets. This creates a second wave of demand pressure that overwhelms the paper shorts, who've been suppressing prices. COMEX faces an impossible choice. Allow the paper price to gap up violently to match Shanghai reality, which triggers catastrophic short squeezes and potential bank failures, or declare force majeure, suspend physical delivery, and settle all contracts in cash at the artificial suppressed price. The first option destroys the derivatives market. The second option destroys COMEX's credibility permanently and proves to the world that Western commodity exchanges are fraudulent. Either way, the era of COMEX price setting ends. The transition might happen gradually through declining relevance as physical trade bypasses New York entirely. Or it might happen abruptly through a default event that makes headlines globally. But the direction is locked in. The gap has revealed the structural weakness. The system cannot survive indefinitely once that weakness becomes public knowledge. For individual investors, the implications are immediate and concrete. If you hold silver exposure through paper vehicles, exchange-traded funds, futures contracts, unallocated vault accounts, you are betting that the Western fractional reserve system survives the stress test. That bet looks increasingly unwise. When COMEX fails to deliver or forces cash settlement, your paper claim gets resolved at whatever artificial price they declare, probably something close to the current suppressed level. Meanwhile, the real metal trades for substantially higher prices in physical settlement markets you cannot access. Physical silver in your direct possession is the only way to guarantee you capture the true global market price. When you hold the actual metal, you're not dependent on exchange solvency, vault custodian honesty, or legal processes that take years to resolve. You own an asset with intrinsic value that can be sold to the highest bidder anywhere in the world. If the global physical price is $130, your Silver Eagle is worth $130 plus its numismatic premium, regardless of what a defunct COMEX exchange says its paper contracts settled for. The window to convert from paper to physical at anything close to Western prices is closing. As dealers wake up to Shanghai reality, as premiums rise to reflect the true global price, the arbitrage opportunity available to retail investors disappears. You can still execute that trade now, buy physical metal in the United States or Europe at 83 plus normal premiums. Hold it through the repricing event. Sell it when Western markets finally acknowledge that 130 is the floor, not the ceiling. This is not about predicting the future. This is about reading the present correctly. The market is providing clear signals. A 56% price gap that refuses to close despite billions in arbitrage profit available. Delivery failures at major exchanges. State-level accumulation by the world's largest industrial economy. Geopolitical incentives to break Western commodity pricing control. The pattern is unmistakable. History will likely mark this period as the beginning of the end for the paper precious metals market as we knew it. The system that allowed Western financial institutions to set global prices through fractional reserve contracts while holding minimal physical inventory is being stress tested to destruction. It's failing the test because the fundamental conditions that allowed it to function Dispersed demand, trust in Western financial infrastructure, lack of coordinated opposition no longer exist. China just demonstrated that a sufficiently large player operating through physical settlement markets can decouple from paper pricing entirely. They've shown that sovereign demand backed by the largest industrial economy on Earth can drain fractional reserve systems faster than those systems can adapt. They've proven that commodity control translates to geopolitical leverage in an era of technological competition and great power rivalry. The $47 gap is not a temporary aberration. It's the market telling you that the emperor has no clothes, that the price on your screen is fiction, that the real value of silver is being discovered in Shanghai while New York clings to an illusion. The question is not whether the paper market fails. The question is whether you're positioned correctly when it does. The era of cheap, paper-suppressed silver is ending. The era of sovereign physical pricing has begun. Those holding paper when the transition completes will discover their claims are worth far less than they believed. Those holding metal will find themselves owning an asset the world needs desperately and cannot produce or acquire easily at current prices. That asymmetry is the entire story. Everything else is noise.